Geopolitical conflicts and market impact, a historical perspective. Recent tensions in the Middle East have heightened global concerns and introduced volatility into financial markets. The escalating situation between Israel and Iran, beginning with Israeli operations on June 13th targeting nuclear and military installations, has evolved into a broader regional conflict. Retaliatory strikes followed, and on June 21st, the U.S. had conducted operations against Iranian nuclear facilities. This conflict continues alongside the ongoing Israel-Gaza war and other regional disputes worldwide. For investors, understanding how such geopolitical events affect markets is crucial, particularly regarding concerns about potential escalation into broader global conflicts. Historical evidence suggests that even significant regional wars, including conflicts in Ukraine, Afghanistan, and previous Middle Eastern disputes, have generally remained contained and produced only temporary market disruptions. The key for investors is maintaining discipline and focusing on long-term fundamentals rather than reacting to short-term headline volatility. Current developments represent a notable increase in Middle Eastern tensions. Israeli operations have targeted Iranian uranium conversion facilities and military leadership, while Iran has responded with missile and drone attacks reaching Israeli territory. Subsequently, U.S. forces struck key Iranian nuclear sites. The conflict has damaged critical infrastructure in both nations, affecting natural gas facilities and oil refineries. Historical analysis reveals that while each conflict has unique characteristics, patterns emerge when examining market responses to geopolitical events. This chart illustrates how markets have reacted to various conflicts over the past 25 years, including Middle Eastern events that affected oil markets, such as the 2019 Iranian drone strikes on Saudi Arabia. These examples demonstrate that despite initial market volatility, recovery typically occurs within weeks or months, with underlying economic fundamentals proving more significant than geopolitical shocks. Oil prices do serve as a primary channel through which regional conflicts impact global markets. The current situation initially drove Brent crude futures above $74 per barrel, though prices have retreated towards $70 amid potential de-escalation signals. Energy price volatility affects the broader economy since oil remains a crucial input for products and services across all sectors. Higher energy costs translate directly into increased gasoline and transportation expenses, affecting both consumers and businesses. The potential disruption of shipping lanes, particularly the Strait of Hormuz, through which approximately 25% of global oil supply passes, adds another layer of concern. However, current oil price levels remain within recent historical ranges and well below the $120 peak reached during the early stages of the Russia-Ukraine conflict in 2022. Additionally, increased U.S. energy independence, with domestic production exceeding 13.5 million barrels a day, provides some insulation from global supply disruptions. Historical perspective reveals that while conflicts may create short-term market reactions, long-term performance depends primarily on underlying economic conditions and business cycles. World War II catalyzed industrial production and transformed labor markets, contributing to decades of economic growth. The Gulf War coincided with oil price volatility, but also occurred during the transformative information technology boom of the 1990s. The current situation's ultimate market impact will depend largely on whether tensions escalate further or begin to subside. While the involvement of major powers and threats to critical supply routes adds complexity, historical evidence suggests that even significant regional conflicts typically have limited lasting effects on global financial markets compared to fundamental economic trends. Geopolitical tensions can create temporary market volatility, but investors benefit by avoiding emotional reactions to headlines. Staying focused on fundamental investment principles and long-term financial objectives remains the optimal strategy during periods of geopolitical uncertainty.